Hello. In this video, I'm going to show you how sensitive the value of the bond is to changes in its life and its yield. Before we proceed, I want to discuss what is yield to maturity. Yield to maturity represents the returns earned by the bondholder when he buys the bond at the current market price and holds it till maturity. When he buys the bond today, he buys it at 931.34. And what does he get? He gets an annual coupon on the bond. This coupon of 120 rupees, he receives it for the period of 5 years, and at the end of 5 years, he gets his 1000 rupees back, which works out to, using the IRR built-in function, this works out to the 14%. This is what is the yield of the bond. As the price of the bond fluctuates, the yield fluctuates. Now I am going to take the life of the bond, which I'm going to put it here on this axis, starting from year 0. I'm going to take the yield, changes in the yield here, starting from say 10%, 11%, 12%, 13, 14, 15, and 16. And I'm going to use the data what if analysis data table and input the life and input the yield, and I get the value of the bond when the life changes and when the yields change. And a few truths are known to us. The bonds mature at face value. On the day of reckoning, the premium bonds hurl towards 1000. So on the day of reckoning, the premium bonds, notice that the premiums have reduced and it is 1000. And on the day of the reckoning, the discount bonds that were purchased at a discount to their face value hurl towards their face value and they mature at face value. Bonds mature at face value. When the yield of the bond is equal to the coupon, the bonds are trading at par. So this is a par bond. When the yield to maturity is greater than the coupon, the bonds are trading at a discount. And when the yield drops below the coupon, the bonds are trading at a premium. So to recap, the yield of the bond is the IRR of the cash flows on the bond, and there is a sensitivity of the price of the bond to the value, the price of the bond and the life of the bond, and bonds mature at face value. There's a convexity attached to the way these prices change. So a 14-year bond, the way its price changes when the yield to maturity changes has been plotted here. And you will notice it is not a straight line. There is a bit of a curve, and that is called the convexity of the bond. And then these are the different bonds and the way they move towards 1000 when the life reduces. Hope this video was informative to you and it was easy to understand. I hope to be making more videos regularly, so please stay tuned and spread the word about this. Thank you.